Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Demonetisation continues to create ripples across the banking system, the economy and, of course, the financial markets. This mega move would have perhaps left you wondering how to manage your money amidst all this volatility. Well, this week, HRISHIKESH, PARANDEKAR, CEO, Private Wealth Management and NBFC at Ambit joins me to help us make sense of demonetisation and its impact on portfolios and, of course, the sort of realignment that might be required to preserve your wealth. HRISHIKESH, it's great to have you on the show. And
thanks for having me.
And of course, he's told me that I can call you Rishi if that's fine. Okay. So, it's brilliant to have you here. And I know that you largely deal with the HNI and ultra HNI clients and you manage their money. But I think there might be some tips that even, the odd retail investor like myself might take away from this conversation. So first things first, right. How disruptive a move is this? Is there a lot that needs to be done to portfolios now?
Well, if you think about asset allocation, right? Asset allocation is dependent on a lot of factors, right? There is tactical asset allocation, there is strategic asset allocation. A big chunk of that is about your risk appetite. It's about sort of what your needs and goals are, as well as then sort of reacting to external stimuli, such as this, right? So this is unquestionably a large stimulus, right? So that is obviously true. At the same time, overreacting to any one stimulus is not a good idea, right? And so one should always keep that in mind. And so fundamental sort of basis of how you're thinking about strategic asset allocation should not change dramatically unless significant changes happen in your own life circumstances, right? Having said that, clearly this is a big move, and to me the biggest sort of impact of this is likely to be in what we see in interest rates, what we see in inflation, what we see in yields. And I think we are getting into a situation where for the next 3 to 5 years, it's quite likely that we will see a significant reduction in rates. That has great news from the standpoint of borrowers, and that has obviously sort of some concerns from the standpoint of investors. Yeah. And so I think that is the fundamental change that is going to happen here, which is going to affect dramatically how you think about your portfolios. Okay.
So help us understand this a little better, because rates had started moving down anyway. There was an anticipation that inflation is under check, so, the RBI will get a little more generous. What is happening now? And also things are changing very quickly. We are seeing deposit rates come down, and then there was a CRR move. Generally speaking, are you expecting a rapid change in interest rates? And then what happens to the fixed income asset class?
So I think the CRR thing that you mentioned, the sort of bulk rates that SBI talked about are short-term moves, right? And I would not read a lot into that. Those are certainly that, something will happen over the next 10, 15 days and they will change. I think more fundamentally, what this is going to do is take us back to where we were probably in 2004-05, where there was sort of a combination of a lot of factors which were actually extremely powerful for the economy. And so I expect this to be a secular change in rates, right? So not counting what we are looking at the short-term thing. Clearly, inflation expectations having gone down over the last 24 months have brought rates down. I think this is going to just accelerate that. The amount of liquidity that comes in, just bringing more finance into the organized sector. All of these things put together will kind of continue to put downward pressure on rates. And I think it's a secular downward thing, which is a great thing from the economy standpoint.
Sure. But what does that mean, as you mentioned, for the investment part of someone's portfolio, the money that should be allocated to debt? We also have a lot of retail investors have been asking the same question, that my FD is not fetching me anything now, if you look at inflation. So, should I get into debt funds? What sort of funds? Because that's another wild world out there.
Yeah, there is a short-term sort of thing, and there's a sort of medium-term view, right? Medium-term view will say that the yields are going to come down, and so hence the allocation that you make to fixed income needs to be thought about in that context. In the short term, there are a couple of immediate opportunities. The first thing you should do is try and lock in great rates while they are currently available. There's a couple of ways to do that. You can do that in terms of sort of invest in bond funds, which are sort of short to medium term, sort of 3 to 5 year term instruments. There are also ways to do it in a structured product sort of sense, where there is capital protection and there is sort of linked to rates-based thing. Right? But I would lock that in immediately, because to me that is an immediate necessity, because if you lose this opportunity, there are two things that happen, right? There's the short-term trade, which basically there's a mark-to-market effect. As yields go down, prices of bonds go up.
So typically you want to capture that.
You want to capture that. And also then if you hold it to maturity, you are holding it something to maturity at a higher rate. So that's the immediate thing to be done.
Let me kind of ask you something fundamental over here. This whole conversation between the accrual strategy versus the duration strategy. I mean, help us understand that. Does it now matter which strategy you're picking because the rate environment is changing so quickly?
I mean, duration is obviously a thing about saying, how long are you locking the rates for? If you are you doing a short to medium sort of 3 to 5 year thing? Are you doing 10 plus year sort of
which means typically government bonds. So gilt
10
would
plus
be,
is clearly only government bonds, right? It's shorter. There are other options. And so in that space, I think longer term, long-term bonds are very hard to sort of predict what's going to happen, right? And so I would be very cautious about that because there'll be a fair amount of volatility in them. Because I think a lot of that impact has already happened. I think there's an opportunity to do something in the shorter duration thing, which is what I'm talking about. And when I say short term, in fixed income, short term is 3 years.
Okay.
Right? Because that's kind of what defines taxes.
Sure.
That's the other thing to keep in mind. In an era where sort of yields go down, taxes become important. We don't know what's going to happen to the tax rates. There's some expectation that we might see some reduction in tax rates to go along with this. But assuming nothing changes or something changes on the margin, taxes become relevant. Right? So at a 10% yield, taxes are less relevant. At a 6% yield, taxes are far more important.
Absolutely.
Right? In that context. And so that's the part of the duration what I'm saying. So I'm saying from a sort of short to medium term, 3 to 5 year term.
Okay.
As far as accrual goes, accrual is essentially about talking about, saying what sort of credit spreads are you going to get, right, in terms of returns. I think that will probably widen, right? I mean, today we are seeing sort of, and so the way I would play accrual is essentially not try to get sort of too cute about that. I would keep it to the relatively higher rated stuff and stay within the short to medium term range.
All right. Well, we've only gotten started. We need to take a quick break. Now we've discussed fixed income, but there's a big wide world out there. We still have to talk about what happens to equities. Should you look at alternate asset classes? What about gold, real estate? We will get into all of that when we come back.